steeper curves in Europe, elsewhere. Mike, walk me through the idea behind that.
Well, this is now the third Mike on the show you have in a row, so it's a good choice on your part. From Mike Wilson's mouth to the market's ears, we would obviously love to see steeper curves in the U.S. Obviously, very good for financials, very good for a lot of fixed income assets, create some value. However, I think it's too early to call for a steepening. I think implied in a steepening is going to be someone who's going to want to sell U.S. fixed income assets. It also implies that the Fed is going to change their rhetoric. That's not happening for many, many years. We actually think we're going to see continued environment of very low rates, very low interest rate volatility, and an enormous amount of demand for U.S. fixed income assets. I think the last thing on people's minds is concern around U.S. fixed income. I think a lot of discussion has been around short-term spikes in inflation in the U.S., and this is the end of the bull market. It's not. It's probably only the beginning.
Mike, it's amazing to see just how unmoved Treasuries have been with an equity market that's down 4 or 5% through September. Mike, when you look at that Treasury market and you start to hear questions about the role of Treasuries in a portfolio, what's your response at the moment?
Well, I still think they play an important role as a balance agent in a portfolio, but obviously less of an impactful role as they did at 3-4% yields. At 3-4% yields, obviously a lot more upside in terms of the potential to rally. Now, what do you have? You have maybe 50, 75 basis points of upside down to zero. But still, fixed income is a really, really important part of people's portfolios. There's still a lot of yield in a lot of aspects of the U.S. fixed income markets. It's not just Treasuries. There's investment grade credit. There's BB credit, which we think is one of the most attractive things right now, kind of the fallen angel that's fallen out of favor with a lot of investors. Agency mortgages, very high quality assets that has the backstop of the Fed, still offering investors a lot of yield. So I think that the death of fixed income has been written, that story, too many times. And I'd say fixed income is still a very, very important part of people's portfolios for yield, but also for diversification.
Mike, if we can just touch on the higher quality part of high yield, so to speak, that line in the sand between investment grade high yield, triple Bs to double Bs. Why are double Bs the sweet spot for you at the moment, Mike?
It's a irrational imbalance in the marketplace. There were a lot of fallen angels that fell out of the investment grade universe this year, late last year, due to the energy crisis, that fell into the high yield universe. And there were insufficient buyers. Investment grade is the #1 criteria that investors write in their investment guidelines. We don't want to take equity-like risk in our bond portfolios, so nothing below investment grade. Also, in the way that bank capital is treated, banks and insurance companies both have to hold exponentially more capital for non-investment grade asset than investment grade asset. So there are some real reasons why non-investment grade is a smaller buyer base. And recently, as you've seen that investor supply increase so dramatically as a result of fallen angels, you've seen massive spread widening. So you can pick up about 275 basis points by just dropping one letter. Drop one letter from triple B to double B, you take on a little bit more leverage, but you are getting paid very handsomely. And so we think that there's a lot of opportunity to be able to get paid north of 400 basis points in spread to go down just one letter.
Mike, just finally from me, you make it sound so simple, by the way, and I'm sure it's not on your side. The spread widening that we've seen so far in the last couple of weeks, and the last week it was about 40 basis points worth. Some people have sat on the sidelines throughout all of this and said, this does not reflect fundamentals. What's been your message, your response to those people, Mike?
Is your question about that the fundamentals would require more spread widening or less?
Yeah, precisely. That 40 basis points still isn't enough for me to come back into the market, that widening is just a taste of things to come. Wait for 650, wait for 700. What do you say back to them, Mike?
Well, I think people have to divorce their analysis of equities and fixed income. They're two different instruments. Equities require earnings, and I need them now, and I need them next quarter and the quarter after that. And if I don't expect the earnings to increase, I don't want to own equities. And right now, over the course of the next 6 months or a year, with the COVID crisis, with a lot of repair that has to happen in a lot of economies, that is a big question around earnings. You add on top of that the risk of potentially corporate taxes increasing next year, and you have a little bit more risk in equities. In fixed income, very different story. We just need enough earnings to be able to pay back your debt. And so this kind of lower growth environment, low rate environment, low volatility environment is actually very, very attractive for investment grade credit as well as high yield credit. And so I think people extrapolate some concerns of equities into credit. And right now, when you have this kind of benign environment on top of accommodation from the central bank, along with a lot of demand outside the U.S., it's a very attractive environment for credit. And don't look to equities for how you should be investing in fixed income.